Okay, let's unpack this. Imagine a future where the dollars in your wallet, or maybe more likely on your phone, move almost instantly across borders, across industries, without all the usual friction or fees we're used to. We're talking about a new era for money right here in the US. Not exactly a new currency, but, well, a revolutionary way to use the dollars we already have. Today, we're diving deep into something pretty monumental: the guiding and establishing national innovation for U.S. stablecoins, or, as it's known, the Genius Act of 2025. Our mission here is really to cut through all the noise around digital assets. We want to break down this complex, potentially game changing legislation, understand its core purpose, and explore what it truly means for you and for the global financial system. We're here to give you the most important nuggets of insight, just trying to make sense of what feels like a massive shift.
Yeah, and what's really fascinating here is that this isn't just, another piece of financial regulation shuffle through. It feels like a landmark moment. This act actually creates the first comprehensive federal framework specifically for payment stablecoins. It's basically bringing let's say, a previously Wild West corner of finance into a structured, regulated environment. It aims to bring much needed clarity and, crucially, safety to a rapidly growing market. It's truly setting a new precedent for how these digital assets will operate within our established financial system.
Exactly. And for many people listening, stablecoins might still sound a bit abstract, maybe even confusing. So before we jump right into the act itself, could you give us a really concise definition? What is a payment stablecoin at its core? And maybe what problem is the Genius Act trying to solve with them?
Absolutely. So at its simplest, a payment stablecoin is a digital representation of a traditional currency, like the US dollar, and it's specifically designed to maintain a stable value, ideally one-to-one. Think of it like a digital cash voucher that lives on a blockchain. It's meant for making payments, for facilitating transactions, not really for speculative trading like some other cryptos. Now, the Genius Act's core purpose, I'd say it's threefold. First, to provide clear regulatory guardrails for an area that has been, frankly, murky, plagued by uncertainty and risk. Second, to foster genuine innovation within this digital dollar market by giving it a safe operating environment, rules of the road. And third, and this is critical, to mitigate the systemic risks that unregulated digital assets could pose to the broader financial system. It's really about creating a safe, trustworthy on-ramp for this technology.
Right, so bringing order to the potential chaos and paving the way for something potentially transformative. And to do that, you mentioned there are two incredibly significant provisions right off the bat.
Precisely. The Act introduces two foundational elements, really. First, a dual regulatory framework. This is interesting. It allows both traditional insured banks and state or federally licensed non-bank fintechs to issue these stablecoins. Now, this isn't just about inclusion. It feels like a strategic move. It acknowledges the role non-banks already play in modern finance. It sort of legislates away the fintech versus bank battle in this specific area by putting them on equal footing, under strict oversight, of course. It's a big departure from past approaches. And second, a strict 100% reserve mandate. Every single digital dollar has to be backed by high-quality liquid assets. We can definitely get into the details on that.
That dual framework is a huge deal, isn't it? It really levels the playing field. It's not just for the massive financial institutions anymore. Our source material really emphasizes this transformative nature, suggesting it's not just tweaking existing rules, it's more like building a whole new payment rail, a new highway for our existing US dollars, like upgrading from, I don't know, a slow freight train to a bullet train for moving money around.
Yeah, if we connect this to the bigger picture, the Act seems meticulously designed to protect the integrity of the U.S. financial system and also preserve the Federal Reserve's control over monetary policy, which is key. By enforcing that full reserve model, it makes sure these regulated stablecoins function purely as a new, faster payment rail for existing U.S. dollars. They don't create new money. That's a crucial distinction. It's about empowering our current currency with next-gen tech.
So making existing dollars work better, faster, smarter, but not creating new ones out of thin air. That's important. And for financial institutions, this isn't a wait and see moment anymore, is it? For you, the listener, understanding this shift is key because it means the financial industry is being pushed, really, to move beyond just watching and start thinking about immediate strategic action. This isn't just theory anymore. It's almost like a call to arms for many of them. All right, let's get into the nuts and bolts then, the anatomy of the Genius Act. You mentioned these key provisions, but what are the specific rules that make this act so powerful? And who exactly gets to issue these digital dollars under this new framework?
Okay, so the Act establishes a very clear dual regulatory system for what it calls permitted payment stablecoin issuers. These are specifically defined. They're either subsidiaries of insured depository institutions, think traditional banks, or they can be state or federally licensed non-bank fintech companies. But these fintechs have to meet the Act's pretty stringent requirements. So this means both the established financial giants and, innovative startups can participate. But, and this is key, under consistent, rigorous oversight. It's a deliberate choice, seems like, to foster competition while keeping things safe.
Okay, and here's where it gets really interesting, and honestly, what probably gives people the most confidence in this whole system, the reserve requirements.
All right.
This sounds like the absolute cornerstone for building trust, especially given some of the turbulence we've seen with unregulated digital assets in the past.
It absolutely is the foundation. That 100% reserve mandate is non-negotiable. Every single stablecoin issued has to be backed one-to-one by high-quality liquid assets, period. And the Act is very, very specific about what counts as an approved reserve. We're talking U.S. currency like actual physical cash, demand deposits at insured banks, U.S. Treasury bills, but only short-term ones, maturity of 90 days or less, and overnight repurchase agreements or repos, as long as they're collateralized by U.S. Treasuries. These are basically the safest, most liquid assets out there. It ensures that if you hold a digital dollar, you can always redeem it for a real dollar quickly and reliably. It's designed for maximum safety, immediate liquidity, and it really aims to eliminate those run-on-the-bank fears that have, plagued some past crypto projects. And it's not just about having the reserves. The Act outlines incredibly rigorous supervision and reporting requirements too. Issuers have to provide monthly public disclosures that have to detail the exact composition and the value of their reserve assets. So you, as a user, could literally go online and see exactly what's backing your digital dollar.
They also face monthly third-party audits by registered public accounting firms, independent verification of those reserves. Plus, there's direct regulatory supervision. The OCC, the Office of the Comptroller of the Currency, oversees federal issuers, and state banking regulators handle the state-chartered ones. This kind of multi-layered oversight is, pretty unprecedented for digital assets.
And what about the things it forbids? That seems just as crucial for preventing some of the past problems we've seen in the less regulated parts of the crypto world, where risks weren't always clear.
Indeed. The Act explicitly prohibits two key activities. This is important for preventing risks and maintaining stability, and it creates a very clear distinction from traditional banking. First, stablecoin issuers cannot pay interest or any kind of yield directly to stablecoin holders. This stops them from directly competing with traditional bank deposits, which have different guarantees like FDIC insurance, and it keeps the focus purely on payments, not on becoming some kind of investment vehicle. Second, and this is critical, there's no rehypothecation. That means the reserves cannot be pledged, loaned out, or reused for any other purpose whatsoever. Imagine a bank being told it absolutely cannot touch the specific dollars backing your account balance to fund someone else's loan. Those reserves are sacred, locked away purely to back your digital dollar. This is fundamentally different from how traditional banks operate on a fractional reserve system, and it's a key part of the Genius Act's promise of stability.
Okay, so just to sum that part up, these rules seem painstakingly designed to build trust, to prevent the kind of instability we've unfortunately seen in some unregulated crypto markets. It's really focusing hard on safety, transparency, and liquidity, creating a very, very different kind of digital asset than what maybe people have seen before. So with these robust guardrails and, well, these new opportunities, how do you see this legislation specifically reshaping the competitive landscape? Thinking about financial institutions over the next few years, what does this all mean for the financial world as we know it, and ultimately for you, the listener?
Well, I think this will fundamentally reshape the competitive landscape in payments, no question. Regulated stablecoins are now positioned to become a credible, low-cost, and near-instant alternative to the traditional payment rails. Things like ACH, SWIFT, wire transfers, which, let's face it, can be slow and pretty expensive sometimes. What's also truly fascinating here is that they pose a significant threat, potentially, to the big credit card networks like Visa and MasterCard. Especially when you think about large business-to-business transactions or cross-border payments, where speed and cost efficiency are absolutely paramount. Think about a global supply chain where payments currently might take days and rack up hefty fees. With stablecoins, settlement could potentially happen in minutes, saving companies, potentially millions.
Yeah, that makes sense. And this must be a huge game changer for banks too, right? Many of them have seemed pretty hesitant about digital assets, mainly because of the lack of clear rules and all that regulatory uncertainty.
Absolutely. For the first time, really, traditional banks have a clear, regulator-approved pathway to engage confidently with digital assets. They can now seriously develop strategies to issue their own branded stablecoins, essentially their bank's digital dollar on a blockchain. They can offer custody services for these digital assets, safeguarding them for institutional clients, which is a big business. And they can start integrating stablecoin payments into their existing corporate treasury platforms, their wealth management platforms. It really de-risks their participation significantly. It transforms what was maybe once seen as a fringe technology into something that could become a core banking offering.
And turning to the fintech world, which is often known for its innovation, this sounds like a massive shot in the arm, doesn't it? Like pouring rocket fuel on their innovation engines, maybe?
Oh, it's an incredible catalyst. Regulatory clarity is huge for investment. It encourages venture capital and corporate investment to flow into this space with much greater confidence, simply because there's now a clear rule book. So we should probably expect a surge of innovation in areas like near-instant, low-cost, cross-border payments. Think about making international remittances cheaper and faster for individuals and small businesses. Imagine sending money to a relative overseas and having it arrive in seconds, for maybe a fraction of the current cost. That's powerful. It'll also likely create more efficient B2B settlement, letting companies move large sums quickly and transparently. And it could significantly improve treasury management for businesses looking to hold and transact in a regulated on-chain digital dollar. And importantly, those stringent requirements we talked about for reserves, audits, public reporting, they're really designed to solve the biggest problem that's held back stablecoin adoption so far, which is trust. It's all about creating confidence for widespread use by both regular consumers and big institutions.
So think about how this could change how you send money internationally, or maybe how you eventually pay for things online, or even just how the businesses you interact with operate behind the scenes. This is really about making those processes faster, cheaper, and fundamentally more secure. Now, one of the biggest questions people often have about really any new form of digital currency is, are they creating new money, potentially devaluing our existing currency? The Genius Act seems to tackle that head on, doesn't it? It's crucial to understand these regulated stablecoins aren't meant to add to the money supply.
That's exactly right. The no money creation clause, which is strictly enforced by that 100% reserve requirement, is absolutely critical for protecting the integrity of the U.S. money supply. Let's be really clear here. Traditional banks, as most people know, operate on a fractional reserve basis. They take in deposits and they lend out a portion of them. That lending process is precisely how new money is created in the economy. The Genius Act explicitly prohibits this for stablecoin issuers, full stop. By mandating that full reserve model, the law ensures that for every single digital dollar created, a corresponding real dollar is held safely in reserve. A good analogy might be a debit card. When you use your debit card, it's just a tool, right? A tool to access existing money already sitting in your bank account. It's not a tool to create new money. Regulated stablecoins function very similarly. They are digital representations of existing dollars, not new ones being conjured up. And this framework also absolutely ensures that the Federal Reserve stays in ultimate control of monetary policy.
The total supply of U.S. dollars in the economy is still determined by the Fed's actions, their interest rate decisions, quantitative easing or tightening, all of that. Stablecoin issuers can only create digital tokens representing dollars that already exist within the traditional banking system. They cannot increase the total supply of money or, compete with the Fed's authority in that way.
Okay, so it's really vital we frame this correctly then. These aren't new dollars trying to compete with our national currency, but rather.
Exactly. It is crucial, I think, to frame regulated stablecoins correctly. They are not a new form of currency designed to compete with the U.S. dollar. Rather, they are a new, highly efficient and programmable payment technology. Think of it as a faster, more flexible rail, a new highway for transacting with the existing U.S. dollar. That distinction is really vital for understanding its potential impact without feeling, maybe, overwhelmed by the concept of digital money as something entirely separate or as a threat to the dollar itself. It's just about making the dollar work harder, faster, and maybe smarter in the digital age.
Okay, thinking ahead now, looking into the crystal ball, maybe. What are the most optimistic, the bull case, and maybe the most challenging, the bear case scenarios for how widely these regulated stablecoins might actually be adopted? Are we talking about a complete overhaul of global finance here, or maybe something more niche, a more incremental solution?
Well, let's start with the bull case, the optimistic view. The long-term vision here is that regulated, fully reserved stablecoins become a core, absolutely indispensable component of global financial plumbing. They could dramatically reduce the cost and the settlement time for, well, almost everything. From international trade finance, where goods move across oceans and payments can lag for days or weeks, to everyday e-commerce, creating really seamless digital experiences, this could potentially unlock trillions, literally trillions of dollars in economic value just by accelerating commerce, freeing up capital that's currently trapped in transit, and just enhancing overall efficiency. In this optimistic scenario, the market for US dollar stablecoins could realistically grow from, say, hundreds of billions today to potentially many trillions of dollars, becoming maybe as ubiquitous and essential as the internet is for information today. Imagine an economy where payments are embedded directly into smart contracts, automating entire supply chains almost instantly. That's the kind of potential.
Wow, that sounds incredibly transformative. But of course, every big innovation, especially one of this magnitude, faces hurdles. What are the potential pitfalls? What's the bear case for widespread adoption? Where could this stumble?
Right, the primary risks, I think, are twofold. First, there's always the risk of regulatory overreach. While the Genius Act provides welcome clarity now, future rules or interpretations, maybe additional regulations down the line, could become so burdensome perhaps through excessive compliance costs or overly restrictive operational demands that they actually stifle innovation. They could make it uneconomical for new players to enter the market. And this could end up concentrating power in just a few large entities, which would limit competition and maybe slow down progress. Second, there's just the inherent challenge of mainstream adoption itself. It's a big hurdle. While the technology is promising on paper, it will likely take significant time, effort, and investment to integrate stablecoin payments into the legacy systems that merchants and financial services providers currently use. And convincing everyday consumers, you, to shift from familiar payment methods like credit cards or existing apps will require solving user experience challenges and building a really seamless bridge. There's no guarantee of widespread success outside the existing, maybe crypto-native ecosystem without a really concerted industry-wide effort to educate people and integrate the technology smoothly. It's kind of a classic chicken and egg problem. Users need the infrastructure to be useful, but building the infrastructure needs the promise of users.
That's a really powerful contrast. So, what factors do you think, as a listener, will primarily determine whether the bull or the bear case wins out here? Is it purely about the technology getting better, or is it more about human behavior, institutional inertia, maybe the wisdom of future regulatory decisions? It feels like a really complex interplay. So, given everything we've discussed, the potential, the risks, the rules, what's the big takeaway? What's the actionable thesis here? For financial institutions, yes, but by extension, for all of us as this landscape shifts, what should people be doing or thinking about now?
Yeah, the actionable thesis here seems unequivocally clear. The Genius Act represents a paradigm shift. It transforms stablecoins from what was often seen as a speculative, sometimes risky, unregulated corner of the crypto market into a legitimate, powerful, and potentially essential new tool for the financial industry. This legislation provides the clarity and the safety that we're missing, the things necessary for mainstream adoption. And that creates both significant opportunity and a real competitive threat for virtually all financial institutions, not just in the US, but globally. This isn't some theoretical future anymore. It feels like it's arriving now. And this means boards of directors, executives at banks, at fintechs, they should be asking some critical strategic questions right now. Like, what's our institutional strategy for digital assets in this new regulated environment? Do we have one? Should we seriously consider becoming a permitted issuer ourselves? Maybe launch our own branded stablecoin? Or perhaps should we partner with an existing issuer? What about offering custody services for these digital assets to our institutional clients? That could be a big opportunity.
Crucially, how can we leverage stablecoins to improve our existing payment services, maybe drastically cut costs, and potentially create entirely new high-growth revenue streams? And just as importantly, what are the defensive implications? What does this mean for our existing profitable business lines, things like credit cards, wire transfers, correspondent banking, as this new, potentially much more efficient technology gains traction? Ignoring it seems risky.
Right. It sounds like one of those moments where moving quickly could be incredibly valuable, potentially even defining who leads this next era of finance.
I think substantial advantages absolutely await the first movers in this newly regulated landscape.
Yeah.
Institutions that move quickly, that invest now to build the necessary infrastructure, establish the key strategic partnerships, and start acquiring customers for regulated stablecoin services. They'll be in a profoundly strong position. They can capture significant market share in what really is poised to become one of the most significant financial innovations of this decade. A wait-and-see approach in this instance carries a pretty significant risk of simply being left behind as competitors establish dominance and those powerful network effects start to take hold. This isn't just about being an early adopter. It might be about shaping the future standards for how money moves.
And even if you're not sitting on a bank's board, understanding these strategic shifts helps you anticipate where the financial world is heading and how it might impact the services you use every day, from sending money to paying for goods, maybe even managing your own finances down the road. It's really about being prepared for what's coming next. So, we've taken a pretty deep dive today into the Genius Act, from providing that crucial regulatory clarity and aiming to build trust, to potentially reshaping global payments, and importantly, ensuring the stability of our financial system. It really feels like a foundational piece of legislation, doesn't it? Truly one for the digital age.
Absolutely. And if we connect this to the bigger picture one last time, the Genius Act isn't just about stablecoins, is it? It's about setting a precedent for how innovation, technological innovation, can be integrated safely and productively into our financial future. It shows how thoughtful regulation can actually enable profound progress rather than just hindering it. It could be seen as a kind of blueprint for the coming digital economy.
So, as you, our listener, consider this deep dive, maybe think about this. What completely new, maybe unexpected services or even challenges might emerge from this regulated digital dollar infrastructure that we haven't even fully imagined yet? How will you personally see these digital dollars integrate into your daily life 5, maybe 10 years from now? Will they be seamlessly woven into the apps you use, speeding up your transactions, or maybe enabling entirely new ways to interact with money that we can't foresee? Thank you for joining us on this deep dive into the Genius Act. We hope you feel a little more well informed and perhaps a lot more curious about the future of finance.